The construction economy just split completely in two. Welcome to the deep dive.
It really is a completely split-screen reality out there right now.
It is. Today is Tuesday, March 10th, 2026. And if you are listening to this, you are likely navigating one of the strangest, most contradictory markets we have ever seen in this industry.
Without a doubt.
I mean, if you were running a massive firm right now, you probably have the most work you've seen in half a decade.
Right.
But if you are a smaller or mid-sized contractor, you might literally be looking for the exit.
Yeah, and what is wild is how incredibly fast this division has accelerated over just the last couple of quarters.
And that is exactly our mission today. We are going to unpack a massive stack of current market intelligence, legal updates, global trends, and the newest operational tech solutions.
There is a lot to cover.
There is. We are going to look at exactly who is winning, who is losing, and most importantly, how you can navigate this current squeeze to actually scale your business instead of just barely surviving it.
Exactly.
Okay, let's unpack this right from the top. We aren't just looking at a regular cyclical dip here, are we? Because this feels different.
It feels different because it is different. We were looking at a fundamental structural shift in the construction industry. Economists call it a K-shaped split.
A K-shaped split.
Right, so the top of the market, the upper arm of the K, is pulling rapidly away and growing, while the bottom arm is facing immense compounding pressure.
Yeah.
It is no longer a rising tide lifting all boats.
Yeah, I was looking through the employment stack you put together, and the hard numbers are pretty sobering for the guys on the ground.
They really are.
In February, overall construction employment actually fell by 11,000 jobs, but the pain wasn't distributed equally at all.
Oh, not at all.
You had residential construction losing 7,100 jobs, non-residential lost 3,800, and heavy and civil engineering lost 6,500.
So it paints a picture of a broad slowdown.
Exactly. It looks like a broad slowdown, but then you look at the backlog disparity and it tells a totally different story. In fact, according to Smart Business Automator's Market Intelligence Report, firms over $100 million have their highest backlog since 2021, while firms under $30 million are sitting at their lowest backlog in over 4 years.
What's fascinating here is the why behind that massive divide.
Right. Why are they doing so well when jobs are dropping?
You see those job losses in traditional sectors, but those top peer firms are thriving. It comes down to one word: mega projects. And specifically data centers. Right now, 37% of large firms are cashing in on data center work. Compare that to just 6% of small firms.
Hold on. So the big players have essentially secured these massive multi-year, multi-billion-dollar contracts that just pad their backlogs for the next 5 years.
Precisely. They are completely shielded from broader economic headwinds because a data center project takes years and incredible capital to build.
That makes sense.
But for the smaller firms that traditionally rely on light commercial builds, tenant improvements, or, standard residential work, that pipeline is drying up quickly.
They don't have that 5-year runway.
Exactly. They just don't have it. This perfectly explains why the phrase construction business for sale is currently surging as a top query on Google Trends.
Wow.
Smaller operators are just feeling the fatigue of fighting for a shrinking pie.
I want to dig into that shrinking pie concept. What does this K-shaped split actually mean for the broader spending picture this year?
To understand that, we have to look at the ConstructConnect Expansion Index. For our listeners who might not track this daily, an index reading above 1.0 means the market is expanding.
Right.
And anything below 1.0 means it is contracting. Overall, the index actually grew for the 8th consecutive month to a reading of 1.14. Sounds great on paper, right?
Yeah, 1.14 means growth.
But you have to look under the hood. The industrial sector practically doubled to a massive index reading of 2.0.
Which is huge.
It is. Commercial is sitting decently at 1.48. But residential and medical construction,
Let me guess, down.
they both contracted by more than 10%. Total construction spending is forecast to be nearly flat for 2026, sitting at just a positive 0.4%.
Okay.
But here is the critical insight for you listening right now. Without those massive data center mega projects pumping up the industrial numbers, the spending forecast for the entire U.S. construction industry would be negative right now.
So the data center boom is essentially carrying the entire industry's growth on its back,
Completely on its back.
masking the fact that everyday contractors are dealing with a recessionary environment. And speaking of the squeeze on everyday contractors, the materials and equipment stack you shared is brutal.
It is very tough out there.
Equipment costs are up 5.6% year over year. That is the biggest jump we have seen in 2 years. It's just another heavy weight on the shoulders of the small to medium business owner trying to maintain a fleet.
And costs aren't just rising on the heavy machinery side. We have to talk about materials and the highly complex legal landscape surrounding them right now.
Right, the tariff rulings.
Exactly. There was a major ruling recently from the Court of International Trade. Judge Eaton ruled that importers are entitled to IEEPA tariff refunds, clarifying that they do not stack on top of standard Section 122 tariffs.
Let's break that down for the guy who is just trying to price out a lumber package or order steel. IEEPA stands for the International Emergency Economic Powers Act, right?
Yes, that's correct.
What does this ruling actually mean for the supply chain and for the end consumer?
So previously, material importers were getting hit with what essentially amounted to a double penalty. They were paying the standard trade tariffs under Section 122 and then getting slapped again with emergency IEEPA tariffs. Yeah. The judge's ruling stops that double stacking and provides some crucial financial clarity for importers. But make no mistake, the overall tariff situation remains a massive factor in building costs.
Because even without the double stacking, the baseline tariffs are still inflating the cost of everything touching a job site.
Absolutely. The financial reality for builders on the ground is shifting constantly. For context, the National Association of Home Builders reports that current tariffs are adding roughly $10,900 to the cost of a standard new home.
Almost 11 grand just in tariffs.
Just in tariffs. And looking ahead, tariffs on imported kitchen cabinets are slated to double to 50% by mid-2026.
50%. Picture being a multifamily developer. Your kitchen budget is about to explode.
It really is. This immense pressure is exactly why we are seeing legislative proposals like the Senate's newly introduced Housing Tariff Exemption Act trying to enter the conversation to provide some relief.
Right, just trying to cool things down.
The push and pull on material costs right now is intense.
We've talked about the squeeze on physical materials, but that is really only half the battle. The paper side, the regulatory red tape we saw in the research, looks just as expensive.
Oh, it is.
If you are running a construction business today, your desk is probably covered in new state regulations. I was looking at the state-by-state breakdown, and it looks like an absolute compliance nightmare, especially in places like California and New York. Break down what is actually changing for contractors right now.
The administrative burden is definitely compounding. Let's start with New York. Their electronic prevailing wage payroll mandate is now officially active.
Okay, meaning what for the back office?
Meaning you can no longer rely on legacy accounting methods for public works. It has to be integrated and electronic, period.
Got it.
In California, they just rolled out 7 new construction laws that drastically increase state oversight. For instance, the Attorney General now has the power to outright revoke a contractor's license over unpaid wages.
That is a huge escalation in enforcement power.
It is. Workers' comp fines have skyrocketed too, now landing between $10,000 and $20,000 per violation. And penalties for unlicensed work have been bumped up to $1,500.
And it isn't just isolated to the coastal states, which is what usually happens with these trends. Washington State just passed a law extending their sanctions so they can now penalize what they call substantially identical companies.
Which targets a very specific issue.
Right, because we all know that one guy in town who gets into trouble, folds his LLC on a Friday, and opens a new one with the exact same leadership team on Monday to escape the fines.
Yeah, the shell game.
Well, the state finally caught on to him. Washington can now track that leadership and apply the old penalties to the new company.
It is a major loophole closure. Meanwhile, in the Midwest, Ohio's new E-Verify mandate officially takes effect on March 19th, requiring strict electronic verification of employee work eligibility.
So the overarching theme here is that the margin for administrative error has just shrunk to zero?
Basically zero, yes.
And on top of the administrative and payroll compliance, there is a massive spotlight right now on job site safety enforcement.
That is a critical piece of the puzzle. OSHA is fundamentally shifting its approach this year.
How so?
They are moving away from random generalized site inspections and pivoting to highly targeted inspections based on specific risk factors, alongside a very strict crackdown on silica dust exposure.
Which means if you are doing heavy concrete cutting or demolition, you are squarely in their crosshairs.
You absolutely are.
But we also have to acknowledge the somber reality driving this shift in policy.
We do. The Bureau of Labor Statistics tracked 1,032 construction deaths in 2024.
Over 1,000 lives lost. That is a heavy number for the industry to carry.
It is. And the urgency behind OSHA's shift has been amplified by recent, highly publicized severe incidents. For example, the recent tragedies in San Antonio,
Right.
where a worker was killed in a retaining wall collapse and another was severely hospitalized after a transformer explosion.
Yeah, that was awful.
This real-world human cost is exactly why we saw search traffic for the term construction safety rebound by 10 points almost overnight. The industry knows it has to tighten up, both for the safety of the crews and to survive this targeted regulatory environment.
Okay, so let's synthesize what we have so far. We have a domestic K-shaped economy where data centers are eating all the capital.
Right.
We have rising heavy equipment costs, heavy tariff impacts, inflating the price of a home by 10 grand, a wave of strict new state regulations, and highly targeted safety enforcement.
It is a lot to manage.
It is, but construction doesn't happen in a vacuum.
Yeah.
I want to shift to the global intelligence stack. If I am a local listener, say I'm just trying to get a mid-sized commercial build off the ground in the Midwest, why do I need to care about international infrastructure moves?
If we connect this to the bigger picture, it is all about competition for finite global materials and specialized equipment. Let's look at Germany.
Okay.
They just established a massive 500 billion euro infrastructure fund. To put that in perspective, that is the largest dedicated infrastructure fund in modern European history.
Wow.
And 58 billion of that is dispersing in 2026 alone.
That is a massive vacuum for materials. They are going to be buying up the exact same steel, concrete, and heavy machinery that U.S. contractors need to build here.
Exactly. And the competition is heating up everywhere. In Australia, they have a record 193.2 billion Australian dollars in construction activity right now.
What's driving that?
A huge portion of that is driven by IEEPA's defense projects. That's the trilateral security partnership between Australia, the UK, and the US.
Oh, right.
They're building massive military and naval infrastructure, which parallels the current surge in US military spending.
What about the UK market? Are they seeing the same boom?
Actually, no. In the UK, overall construction starts have declined by 10%. Because residential is lagging, their non-residential and commercial sectors are becoming their major counter-cyclical play.
Meaning they're leaning into commercial builds just to keep their industry afloat?
Exactly.
Yeah.
But the most disruptive global shift right now is happening in the Middle East.
You're talking about the NEOM project in Saudi Arabia.
Yes, the massive NEOM Megacity project just confirmed a strategic freeze on certain luxury developments.
Which make huge headlines.
It did. But instead of just holding on to that capital, they are aggressively pivoting to become a global data center hub.
Wait, explain that to me. The Middle East is known for massive luxury and oil infrastructure. Why are they suddenly pivoting to data centers?
Because data is the new oil. And AI requires unprecedented computing power. This pivot means U.S. firms need to completely reassess their supply chain exposure.
I see where you're going with this.
You are no longer just bidding against the general contractor across town for materials. You now have Saudi sovereign wealth funds competing for the exact same highly specialized power transformers, HVAC systems, and cooling equipment that domestic contractors need for U.S. data center projects.
Which creates a massive bottleneck for critical components.
Exactly.
That is wild. Speaking of international news, I have to bring up this specific fact from the research stack because it sounds like science fiction.
The Japan project.
Yes. In Japan, the construction giant Kojima has achieved fully automated 247 robot-built dam construction. They literally have automated heavy machinery building a concrete dam around the clock with almost zero human intervention on the actual pour.
It is an incredible technological leap, and it shows where the absolute cutting edge of the industry is heading. But there was a very practical, crucial lesson here for the listener.
What's that?
The takeaway isn't that you need to go buy a fleet of autonomous bulldozers tomorrow to survive the current market squeeze. The lesson Kojima learned, and what they emphasize in their own reports, is that you must implement lean processes before you attempt automation.
Right, because lean is all about standardizing workflows and eliminating waste. If you try to automate a broken, inefficient, chaotic process, you don't get efficiency. You just get very expensive, very fast mistakes.
Precisely. You cannot just throw robots or even basic project management software at a workflow where nobody agrees on how a daily log should be filed or how an RFI is tracked. You have to standardize your operations first.
Which brings us perfectly to how smaller businesses are actually finding a lifeline right now. They can't buy robots, but they are actively hunting for ways to streamline and survive this administrative and financial squeeze.
Yes, the search trends are very revealing.
The trend signals we pulled from just this past Monday are fascinating. Searches for general contractor jumped from an index of 62 up to 81. Broad construction business searches rose to 39, and the SBA Surety Bond Guarantee Program just hit a record $10.6 million, supporting 2,200 small businesses.
So contractors are actively looking for help.
Exactly, for financial backing and for better ways to operate.
And beyond just financial backing, they are desperately looking for ways to predict their costs more accurately before they even break ground. If we look at Smart Business Automator's Market Intelligence Report, searches for estimating services just saw a massive 51,350% breakout.
A 51,350% breakout. That is not a typo. That is pure desperation from the market for accuracy and efficiency in the pre-construction phase.
It is a massive signal. It tells us that the way out of this K-shaped squeeze for the small to mid-sized contractor isn't just trying to work harder or putting in 80-hour weeks or hiring more bodies.
Right.
It is about fundamentally reducing manual coordination and stripping away the administrative burden that eats up a project manager's day.
Let's talk about the strategy of how to actually do that, because the administrative red tape we talked about earlier is drowning people. How do you scale when you can't afford to hire 3 new administrators?
That's leverage technology.
Well, looking at the capabilities of modern platforms, let's use Smart Business Automator as an example here, since we've been looking at their market report. It's all about leveraging AI to recover time.
Exactly.
Just looking at document and data management. The strategy now is utilizing smart document organization that auto-tags photos, plans, permits, and RFIs as soon as they are uploaded.
And pairing that with natural language smart search. Imagine not having to remember exactly which nested folder a specific change order from 6 months ago is saved in.
That sounds like a dream for most project managers.
You just ask the system for the document as if you are asking a human assistant.
And that ties directly into how AI intelligence is fundamentally changing project management. Think about document intelligence, having a system extract the hyper-specific details from hundreds of pages of architectural specs so a PM doesn't miss a critical, expensive requirement.
Or RFI assistance. Instead of staring at a blank screen, the AI drafts RFI responses by instantly pulling context from your historical project data.
That is where the real leverage is.
It can even take those rambling voice-to-text field notes that superintendents record while walking a site and automatically turn them into concise, formatted daily logs and meeting summaries.
That alone saves a project manager or a superintendent hours of desk time every single week.
Absolutely.
But what about risk and financial oversight? Because when margins are this thin and cabinet tariffs are jumping 50%, you cannot afford to find out a project is bleeding money at the end of the month. One bad bottleneck can ruin a whole quarter.
That is exactly why you need software that spots the fire before it starts. Features like schedule risk detection analyze the entire project timeline to flag logistical bottlenecks before they actually blow up the schedule.
Right.
It pairs that proactive detection with budget and variance insights, which track cost movements in real time, and perhaps most importantly, change order impact analysis.
So before you even approve a change order, you can see exactly how it will ripple through your timeline and your budget.
Exactly. You aren't guessing. You are making data-driven decisions. And synthesizing all of this creates what we call operational health.
Operational health.
Yes. Automated report generation keeps stakeholders and owners updated without manual data entry. You utilize compliance and spec checking to catch gaps before they become incredibly expensive rework.
Which is huge with the new state regulations.
And systems now include an AI project assistant with custom workflows and API integrations, meaning it actually talks directly to your existing ERP and accounting software.
So it isn't just another siloed app. It is the central nervous system of the business.
Precisely.
If we synthesize everything we've covered today, the picture of the industry is incredibly clear. The massive billion-dollar players are thriving by gorging on multi-year data center mega projects.
Yes.
Meanwhile, the smaller and mid-sized contractors are facing a brutal gauntlet. Rising heavy equipment costs, a maze of strict new state compliance laws, highly targeted safety crackdowns, and a global market where sovereign wealth funds are fiercely competing for the exact same materials.
It is an incredibly heavy load to carry for a business owner, but the great equalizer here is adaptation.
Right.
Adopting lean processes first and then integrating AI-driven technology is how a single project manager can suddenly handle 5 jobs seamlessly instead of struggling to manage 3.
Yeah.
It is how you scale your operational capability without linearly scaling your overhead costs. The contractors who survive this K-shaped split won't necessarily be the ones who swing hammers the hardest. They will be the ones who manage their data, anticipate their risks, and streamline their administration the smartest.
Which leaves us with a pretty wild, provocative thought to chew on this week. With automated robots working 204/7 to build concrete dams in Japan, and AI handling the heavy lifting of project management, risk detection, and daily logs, will the most successful local construction owner of 2035 look more like a software engineer than a traditional builder?
That is the million-dollar question.
It really is. It is something to seriously think about as you look at your own workflows and your own scaling strategy this week.
Absolutely.
If you enjoyed this deep dive, make sure to subscribe, rate, and review on your preferred platform. Share this with your team, your foreman, or any colleagues who are feeling the squeeze of this current market. And to learn how to scale your business without drowning in paperwork, visit smartbusinessautomator.com. Stay sharp out there, and we'll catch you on the next one.